Hello everybody and welcome to Options Discovery on John Lothian News' The Spread. My name's Alex Teng and just like many of you, I am no expert in the world of options. But with the help from some, we can learn more about options together. In this week's episode, we're going to be talking about short-dated options. And later in the episode, we get the chance to sit down with Sean Feeney, the head of US options at Nasdaq. Sean is going to break down short-dated options as well as give us a little insight into the advent of zero DTE options. So that's an interview you're not going to want to miss. First, we need to talk about the concept of short-dated options. What are they? How do they work? Well, essentially, short-dated options are just options with a shorter time to expiration. An example of this could be a weekly option, which is listed on a Thursday and expires the Friday of the following week. There are many different benefits to trading shorter dated options, and they all center around the time until expiration for that option. The more time until expiration an option has, the more time value that option is said to have. And this is because the longer an option has before it expires, the higher probability that that option will expire in the money, all else equal. If you have an option that is far out of the money and expires tomorrow, the odds that that option will expire in the money is very unlikely, as the underlying would have to make a huge move in a very short period of time. The time value of an option erodes faster the closer that option gets to expiration. This means that short-dated options are very exposed to this time decay, aka theta. The theta of a short-dated option introduces an additional layer of risk for the short-dated option holder, as now they have to manage the increasing risk of time decay. On the other hand, if a trader has a strong conviction on upcoming short-term moves in the market, they may want to use shorter-dated options to take advantage of the market movements. This is because the reduction in time value for a shorter-dated option makes it a relatively more inexpensive way to take advantage of those upcoming market moves. But of course, like many strategies, the key to this is going to be timing. You need to make sure that the market moves in the direction you want it to within the period of your short-dated option. Because if the market moves after your option expires, well, that option is already expired worthless and you're not taking advantage of the moves in the market. So in order to use short-dated options to take advantage of short-term market moves, you need to have timing, which is easier said than done. Many traders and firms use shorter dated options as a way to hedge their risk in the short term. This is because short dated options could be a relatively inexpensive way to alleviate risk by reducing directional exposure. This can be done through a variety of methods, such as delta hedging, where traders get the net delta of their position as close to zero as they can by using options and the underlying asset, such as a stock. Delta hedging is one way to reduce directional exposure, leaving volatility risk as the main concern. Although we mainly covered weekly options as the example in this video, the time until expiration for options can get even shorter than that, and that's where zero DTE options come into play. Some exchanges offer zero DTE options, which are essentially options that are expiring at the end of the day. It is important to note that zero DTE options are not listed on the exchange the same day they expire. Zero DTE options could have been listed weeks ago, and they are only zero DTE options because they are expiring on the day. To talk more about short-dated and zero DTE options, let's sit down with Sean Feeney, the head of US options at Nasdaq. Sean is an industry veteran with multiple decades of experience in the options and derivatives industry. Sean has been with Nasdaq since 2016 and has overseen the absolute explosion in options trading volume that we've seen over the past couple of years. Without spoiling too much, please enjoy my interview with Sean Feeney. Thank you everybody for coming back. So it's another episode of Options Discovery. This one is live with Sean Feeney. Sean, thank you so much for coming and being with us for this live interview. So
Alex, great to be here.
Can you start off by introducing yourself, your background, and how you got to where you are today?
Sure. I'm the head of US options at Nasdaq. I took that role in January of this year. I'm humbly honored to represent Nasdaq in that capacity. My career spans back to around 1996. I've had an unorthodox and rather storied travel through the industry and through my career. I never graduated college. And when I started working, I actually worked in a similar kind of offshoot firm to something you might have seen out of The Wolf of Wall Street. And yeah, it was a chop shop brokerage firm. I knew nothing about nothing, and I barely knew what the S&P 500 was. So I studied for my Series 7, and I realized very quickly that wasn't the business that I wanted to be in. Right. So I did a few odd jobs, and then I ended up meeting someone who was a specialist on the floor of the American Stock Exchange. And he asked me, as I was teaching tennis to his son, if I would want to come down and be his clerk. And just a wonderful, wonderful man. Gave me my big break, so to speak. And I started on the floor of the American Stock Exchange as a specialist clerk in April of 1999. I clerked for that gentleman for a few years. And then I got my next big break, which is to become a member of the exchange. The firm that I was working through was essentially absorbed into another one. And then September 11th happened. We went down to Philadelphia after the Amex was closed down, and I got the opportunity to really showcase some of my trading chops, and I became a specialist. Later, I guess in early 2002, I was a market maker in a couple different crowds. And then I worked down on the floor of the Amex until 2008. In 2008, I left the floor and I took a shot to go start my own fund. I walked that directly into the global financial crisis. So let's say it didn't end well. But I was able to regroup and through industry connections and relationships, ended up coming back to New York. I worked at Knight Capital Group for a bit. I built out some interesting product on the agency side of their electronic offering and options, which was kind of nascent at the time, and worked down there. I worked at a few buy-side shops after that. I traded a volatility dispersion book for quite a while. Then I took a few years out of the industry. I did some traveling, I did some investing, and I tried my hand at a few other startups that didn't quite work out. And then in December of 2016, I started at Nasdaq in a sales capacity, moved over to the business team in 2019, and eternally grateful for Nasdaq for kind of breathing a next leg and new life into a career that was long and storied. Like I said, it's had kind of its twists and its turns, and since I've joined Nasdaq, it's been all uphill. And Nasdaq's been just a wonderful company to work for. And this industry, as I've been in it since I was 21 years old, essentially, is just I can't think of anything I would rather be doing. I just cannot. It's amazing.
Yeah, well, it seems like you have a really broad breadth of experience over your career, intentional or unintentional. So to that end, right, obviously being here at OIC, we're hearing a lot about these shorter dated options, right? Which you
didn't say zero DTE.
I did not say zero DTE because we'll get into that in a second. But just to kind of talk about these shorter dated options as a product and maybe some of the offerings that Nasdaq has, can you give us a quick overview of what these are? And it seems like the misconception is that these are new products, but it seems to be more of an evolution over time. So maybe to talk to that perspective as well.
Sure. So we'll go with the overall history of the lesson, right? So the options industry was born 50 years and 2 days ago. All right. April 25th of 1973.
Recent birthday.
There were 16 products where options were launched. Among them were AT&T, McDonald's, Xerox, all of which I traded when I was a specialist on the floor of the Amex, just by happenstance. But and the options that were listed were 3-month, 6-month, and 9-month options.
Yeah.
Right. So options are essentially rights that you can purchase, and I'm not necessarily sure as to the education level of the community watching the program, but we don't have to go into exactly what options are. And then over time, as it was only calls at the time, also in 1973, introduced puts, and then really kind of codified the structure of options and having these like third Friday expiration cycles, right? So options were traded in fractions in 2002, 2003, moved into decimalization. The first electronic exchange, the ISE, which was launched in 2000, introduced kind of this complex order regime that didn't have to go through the floors. And then, the electronification of the business has really kind of taken off from there, where now we have 5, soon to be 6 exchange groups, 16, soon to be 18 options exchanges in the US, a fragmented liquidity profile, but each one of these exchanges services a different kind of subset of customer.
Yeah.
Right. So kind of moving through just the evolution. In 2005, there were, say, index options that were launched with weekly Friday expirations. In 2010, 2011, those weekly expirations leaked into the equity landscape and the ETF landscape. And I'd say they started to gain popularity throughout the teens, and more so as the investor focus had started to shift to more shorter duration trading. Then there's been an increase in the amount of available product in that space. So in 2016, there were Wednesdays that were listed in SPY and QQQ, and then Mondays were listed shortly after that, and then it's 2018, 2019. Tuesdays and Thursdays were listed last year in SPY and Qs.
Yeah.
So now you have expiry cycles that are every day of the week.
Yep.
However, these are not daily options. I want to make sure that everyone understands that these are weekly options that are listed at least 2 weeks, up to 3 years before the expiry date.
Yeah.
Right. So there's been a lot of press around daily options and the risks that may exist because of the existence of these products. Mm-hmm. These are weekly options that expire every day. And the zero DTE phenomenon that has been really showcased in the media is essentially that there are a lot of options to trade on the day of expiry. And just some facts from 2014 to today. If you look into the more actively traded equity names and you just look at the weekly expiration cycles on Fridays alone, you would actually notice that in just the Amazons and Apples and Googles and Netflix, I had in there NVIDIA, in my data grab here.
Yeah.
Approximately 40% of all of the options that were traded on those Fridays where there were expiries were in the expiring series, which is now known as this phenomenon as zero DTE.
Yeah.
And so when we hear that there's an uptick in the amount of zero DTE options that are trading, that's because of the availability of this product that happens to expire on those days, right? So, the market makers and liquidity providers in the industry do an amazing job of managing risk. Retail traders tend to be net buyers of options overall. So systemically, that's not necessarily a quote unquote risk. Naturally, options do incur risk, and please read through the OCC option disclosure document. Nothing that I say is any.
It's not strategy.
Right. It's not an offer to buy or solicitation to sell any security at any time, right? We make sure that we have our disclaimers and that the lawyers that have done such a wonderful job of protecting us over the years get their fair share. So, thank you very much, lawyers.
Well, great nod there. And it just goes to show, right, some of the misconceptions that may be prevailing in the media or public opinion, right, with how these products work. And maybe some of that lends itself to the fact that to some parts of the market, right, they're not familiar with options because sometimes it's seen as a more confusing instrument, as we say. So that's kind of the goal of this show, right, to kind of break these things down. But one thing I think is interesting, right, is this zero DTE phenomenon, right? Because it's not a product; it's kind of the culmination of these non-Friday expiries, right? And
thank you for using my word.
The non-Friday expiries.
We're at the Options Industry Conference. We had a panel, and I was very explicit to state that zero DTE is not a product. It is a point in time, right? It is the point in time where there is less than a day until the option expires, and where a lot of that trading really does occur. And there's a smattering of opening and closing of positions. There is a bit of speculative activity on that 0 day itself. And the risks that are associated with that are very well known inside of the industry, very well absorbed by the liquidity community. And we as an industry are incredibly responsible about the product that we wish to list, that we're going to list, that are listed, and we make sure to gather as much feedback from the industry as well as educate and get feedback from the regulatory community, who also needs to be in the know because they have to approve these products, and the Securities and Exchange Commission, who ultimately does approve product for listing and trading, they're going to take a very responsible approach as well, because it is their job, as it is our job, to protect the end user and protect the investor. And I think the industry does a wonderful job of it. I think the Commission does a wonderful job of protecting the end user in the options industry and the options asset class. And I think that the industry also does a great job of educating, and you are doing a service to the industry right now by providing some of that education and by providing a forum for us to get down into the nitty-gritty of some of the market structure topics that are in existence today, and some of the give the listeners and the viewers of the program a bit of a lens into what it is that we're talking about behind closed doors and in the open, because they are the same conversation.
Yeah, and I appreciate you providing that lens, right? And to talk about where you see the trends for some of these shorter dated options, right? We see the quarterlies, the monthlies, weeklies. Where have you seen a lot of that volume coming from? Is it more on the retail side, more on the institutional side, or is it a little bit more complex than that?
It's a little more complex. It's a little bit of both, right? So, and just a little bit of a history and the growth that we've seen. Yeah. And I hate providing all these history lessons, right?
Yeah, that's what we're here for.
In 2018, I'd say we're trading around 18 million contracts a day. Last year, we were around 39 million contracts a day. It's 115% growth over a 5-year period. So we've seen an immense amount of interest in these products, and that interest has come from naturally when in 2019 commission rates started to move down and towards zero. We went through the pandemic period and work from home environment. Some additional funding that was provided by the government also kind of leaked into the industry a bit as well. The meme stock craze took that to another level, and retail kind of topped out. When I say retail, I mean just your user of a retail platform. I won't make any shameless plugs to any in particular, because we're completely non-biased and broker agnostic, but use the platform of your choice. And it's 2021 or so, I'd say around 60% of the options volume that was trading in this entirely elevated option environment was retail. But to move more closely to the question itself, when it comes to these shorter dated options, there are only 3 ETFs that have alternative expiries, right? So these are not daily options. They are weekly options with alternative expiry cycles. Yeah. Right. IWM has options that are available to expire on Mondays, Wednesdays, and Fridays. QQQ, the Nasdaq 100 ETF, has options that are available for expiring every day of the week: Monday, Tuesday, Wednesday, Thursday, Friday, as does the S&P 500 tracking stock SPY. But those are the only 3 products that are quote unquote this zero DTE phenomenon. Yeah. However, zero DTE as a construct has been around since the first expiry, which was July 31st of 1973. On July 31st of 1973, the first option expiry, there was zero DTE trading then, and zero DTE on every expiry in every equity and every index and every future that has an optionable product, a vanilla options product associated with it, has a zero DTE event on every expiration date.
So the only inevitability is death, taxes, and the fact that your option will expire. DTE. Yeah, there you go.
Death, taxes, and zero DTE.
Awesome. Well, that's really interesting. And I know Nasdaq, obviously a Goliath in the equity business, right? Can you talk to maybe some of the synergies between those two sides of the exchange, right? Where you're at with the options and maybe the equity side of the business as well?
Sure. I'd say when people think NASDAQ or they hear NASDAQ, at least people that are my age, they're like, well, NASDAQ is a 4-letter stock symbol, right? Whereas the 3-letter stock symbols would trade on a different exchange. NASDAQ was the first electronic trading venue in 1971. We started, the NASDAQ stands for the National Association of Security Dealers Automated Quotations. So we were the pioneers of electronic trading in equities. So we have now we own three equity exchanges. We own 6 options exchanges, and so they complement one another. And we also have a very large listings business, equity listings business. We operate a market technology, a market surveillance, and market regulation business. All of these businesses, as well as an anti-money laundering, anti-financial crime arm that we have internally. We have market data distribution, alternative data, hedge funds, meeting allocators, all of these different businesses. They all complement one another in a beautiful and global ecosystem.
Yeah.
And so equities are a natural hedge for options. So our customers and clients who are trading options are going to utilize their equities to hedge, might utilize options to hedge. We don't currently have a futures business in the United States, but they could utilize futures to hedge. So like all of these asset classes are all coordinated. And then we also need to regulate that market. We have our market surveillance internally to our North American Transaction Services Group. And then we have a kind of more global regulation infrastructure outsourcing engine that we provide through our market technology team. So Nasdaq, through all of its properties and all of its silos, all works together in conjunction in order to service the public.
All right, everybody, thank you so much for watching this episode of Options Discovery. I also want to say a thank you to Sean Feeney for taking the time to sit down and share his knowledge in the options industry. All right, everyone, that's going to be it for today's video. I'll see you in the next one. Bye. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.